like, to the crisis. And very soon, by doing that, they actually created relatively full employment in Paris, and they got out of the problem. Of course, they did a lot of repression of workers' movements at the same time, but you know, it was just by the by, as it were. But in order to do that, they needed new financial institutions. And they had those Saint-Simonians who kind of said, look, the association of capital is essential to the development of large-scale projects. Therefore, we have to build institutions which associate capital. And the Pereire brothers set about building those institutions. The municipality set about building those institutions. So there was a financial revolution which lay at the root of the transformation of Paris and the building of the boulevards. Now, at each time, back in the 1930s, very interesting, back in the 1930s, the crisis of the 1930s, it was suddenly recognized around 1935, 36, that about a third of the unemployment in the United States was due to unemployment in the construction industries. So what did they do? They suddenly went and reformed all the financial institutions. This is when the FHA was set up, mortgage finance was rationalized. This was all built up in the sort of legislation of 1937, where they revolutionized the financial structure with the idea, as I said, of converting as many people in America to debt-encumbered homeowners as they possibly could. Then comes World War II, which absorbs the surplus. I mean, that's another way you can get rid of it, of course. So that absorbs a lot of the surplus, but then 1945, they're faced with the fact that they're going to have all of these people coming back from fighting for freedom and justice, and what the hell's going to happen if they go back into the conditions of the 1930s? Well, they did the GI Bill, that's when the mortgage interest tax deduction came in, all this kind of stuff, and they actually set up a whole thing to suburbanize the United States, build the highway systems. All of that was one great way of absorbing the surplus. A superb way. That's the way they came out of the crisis of that time, but by the time you get to the end of the 1960s, it's going a little wonky. And the whole suburbanization of the United States then becomes one of the ways of absorbing it, but it is through, again, the revolution in financial institutions. So the revolution of financial institutions becomes fundamental to the history of capitalism. And it's no surprise whatsoever that the way we got out of the last crisis in the 1970s entailed a revolution in the architecture of financial institutions in the worldwide. It had to. You couldn't have globalized and offshored in the way you did, and if you didn't have that. But of course, the whole currency system has broken down, and so there's uncertainty on exchange rates. So what do? They set up a currency futures market in Chicago in 1972. So you start to get this whole wave of innovation which has gone on in the financial area, which is absolutely, I mean, it wasn't accidental. It was absolutely necessary for the kind of solution they were pursuing around the labor question and the rest of it. So the financial stuff is very, very significant, and how it's done. Now, there are two things that happen there. You can get inadequate financial institutions, and you can get a crisis because of that. You get what's called financial repression. And then there's big pressure on revolutionizing the financial institutions. But as you revolutionize financial institutions, what happens is the financiers get a lot of independent power. And yes, they get greedy. Why not? I mean, if you're in that position and you're actually in a power to dictate, they start to take a big cut in way of interest. And the power structure, the power relation between finance and what it is financing shifts. If you look at corporate profits in the United States, manufacturing profits are just zoom. Financial sector profits, zoom. It now accounts for about 40% of the profit, well, not about now because it's changing, but you know, it was accounting for around 40% of profits in the United States were earned by financial institutions, as opposed to 15% sort of back in, you know, sort of 1980 or whatever it was. So this is one of the problems. The second big problem is the labor. And I've already talked about that, and I'm not going to go into it. But obviously labor is potentially a barrier, and it was a barrier back in 1970s, but it's no longer one. So we can work past that. The third barrier lies in the area of means of production. And this is a complicated story about, you know, getting parts here from there in the right kind of order, and there are all kinds of ways in which that can go wrong. But behind it lies also the kind of question of, are there limits in nature? Are there limits in natural resources? And there's a lot of argument about that. Do we have at the back of this peak oil, blah, blah, blah? Is it something to do with the relation to nature? And that is a potential barrier, and many people will look at it right now and say that is one of the potential barriers which we're encountering, though I'm myself not fully persuaded of that. Historically, capital has been extremely sophisticated in encountering seeming limits in nature and transcending them. And this is, I think, one of the things we have to watch out for this time. And transcending them in ways which are a little surprising, not simply by technological change, but by all sorts of things. And right now, if you wanted to solve the environmental problem, there's no way you can do it by technology alone. For instance, I believe if you want to really go at that, you have to completely revolutionize the way of urban life. Because the system that was set up in the United States through suburbanization is profligate in relationship to land and to energy consumption. And so if that is the nature of the problem, then you don't find new energy sources, you just say change the pattern of urbanization. So that is a potential problem. The technological organizational form is an interesting kind of question. Again, those change. If they change too fast, then before the old fixed capital has been amortized, you get a crisis. If you don't change fast enough, then you can't raise productivity in the right kind of way. So there's all sorts of delicate issues around technology and organizational form. And in recent times, I would make very emphatic that it's organizational form as much as hardware or technology which matters. The reason Walmart has been so successful is because of its organizational form, not because of its technologies. And I think that this is obviously you use technologies in making the organizational form, but I think it's very important to make that distinction. So there's a potential blockage and a point where you can actually generate crises of various kinds. And then there is the question of discipline on the shop floor. Again, that was a problem in the 1970s, largely solved right now. I don't hear anybody saying there's a big problem about that, because capital can simply go to wherever it's most disciplined labour force. The last thing is, of course, the effective demand problem. This is often referred to in classical kind of Marxist discussion of this as the underconsumption problem. And if you're an underconsumptionist, you're a Keynesian and you're not a proper Marxist. People would say those kinds of things. But actually, if something emerges as an underconsumption problem, you have to call it what it is, and it is an underconsumption problem. Where are you going to find the market? Now, what Marx did was to assume the market could be actually acquired through primitive accumulation. You just go steal gold from, around the world and that kind of stuff. And there was plenty of gold reserves amongst the feudal classes, and you could actually use that as your big market. I mean, you'd sell all the goods and get them indebted and make them buy stuff, and so, the initial bourgeoisie was very much sort of absorbing all of the excess demand that existed in the feudal residuals, if you like, the gold reserves of the feudal classes. Well, most of those have disappeared right now, although as we notice, the Vatican has a lot, and they probably have to sell them off to pay for the sins of its priests. So but actually that's not going to be a big market, no matter what. The other argument that Rosa Luxemburg said, well, there's something outside of capital that exists where you can sell it to. You can get the Indians to sell opium to China, and the silver comes to India, and then the Indians pay for all the textile goods that are coming from Manchester with the silver that came from China via the opium trade. I mean, those kinds of things. That doesn't exist anymore. That the global capital has become such that actually there's no outside. So the market has to be orchestrated inside. And how is it orchestrated inside? Well, the only way it can be orchestrated inside is very interesting. It's about saying the expansion tomorrow pays for the expansion of yesterday. Put in physical terms, the surplus product you generated yesterday is going to be taken up in the expansion of the system tomorrow. This gives you your 3% compound growth, if you like, why you have to do it. But there's a time lag there. And that time lag says the only way you can get from yesterday to tomorrow is actually by invoking credit and using money as a means of payment. So the financial institutions come in at the end of the story as well as at the beginning. They become absolutely fundamental to how this system works. And the simplest way to think of that is, you would find systems in Southern California where a financier was lending to a developer to develop tract housing, and then was lending to the people who bought the tract housing. Okay, so actually capital, finance capital, was working on both ends. It was working on both the supply and